Good afternoon everyone and welcome to the Morrows Monthly update for January. 2012 finished strongly and we've seen that continue into 2013. The fiscal cliff's been averted for now, the debt ceiling's been pushed back and we've seen a pick-up in investor confidence. January saw strong equity gains across the board. The Aussie and US markets are up around 5%, Europe was up 4%, Japan was up 7%, with China also up 5%. Bond yields in the safe haven regions rose as the risk trade took hold, and peripheral bonds yields started to fall again, which is positive for markets. On the commodities front, we saw oil up 4%, gold up 2%, and most other industrial commodities also stronger for the month. The Aussie managed to rise as high as 106 against the US before falling late in the month. It also fell against the euro and the pound, but rose against the Japanese yen. On the economic front, we saw softer data in January for the US as consumer sentiment unexpectedly fell, and we surprisingly also saw the GDP numbers in the fourth quarter contract in the US economy, raising fears of a potential recession. In Europe, German data was strong with manufacturing and consumer confidence. However, this was offset by the unemployment rate in the Eurozone rising to its highest level of 11.8%. Chinese data was very strong with manufacturing, retail sales and GDP growth all surprising to the upside. Inflation came out marginally higher but is not a concern at this stage. The domestic market still seems pretty mixed. We had business confidence and consumer confidence rise, however unemployment also marginally rose. Inflation did come out lower than expected, so that gives the RBA further room to move if required. The RBA at its recent meeting left rates on hold as expected, but the market's still looking for further cuts. January tends to be a seasonally strong month for equity markets, and this year hasn't disappointed. In saying this, a lot of the rally has been attributed to PE multiple expansion as opposed to underlying earnings growth. The reporting season is now upon us, and we need to see some strong reports from companies in order to justify the current prices and valuations. Our portfolios have been positioned for a lot of the market upside, but we've also maintained a focus on protecting downside. Cash rates are now sub 4%, term deposit rates are no longer looking as attractive, so we need to focus on other asset classes that will provide us with strong risk-adjusted returns. We're continuing to monitor the investment markets and looking for opportunities, and with various valuation changes, we will look to rebalance portfolios in the coming months. We thank you for your time today, and we look forward to talking to you next month.